Hello. This is the setup that's going to make me millions of dollars. First, firstly, the basic rundown and what we need for this to work is one, high time frame draw on liquidity must be retraced into or taking, or what's a better word for that? Must be retraced into or taken out, let's say, swept. So fair value gap or high or low. So that's the first objective. High time frame. It's an example of this. Mainly okay. Mainly hourly highs and lows slash hourly fair value gaps. Main source of liquidity for special occasions. It can be 15-minute fair value gaps that are untouched. Now, why does it matter if it's untouched? Because it hasn't been equaled out yet, hasn't been used, and that's important if it's a 15-minute fair value gap. Because on the hourly and the 4-hour, those fair value gaps, we just want them to be respected. It's better if the hourly fair value gap hasn't been tapped into yet, but we can still use it. 2, we need to disrespect fair value gap on the entry time frame. After that, 9 out of 10 times, we need to have a market structure shift. If on the 1 out of 10 times, we either don't have a inversion fair value gap or market structure shift must reduce risk by half. Stops, now 3. Stops should be where trade has been validated. Better the closer stop is to the highest / lowest point before shift in structure. Notes. 4 hour can be used for direction of overall bias and can support further bias or can support for a stronger bias. Example would be we take out hourly high / low or retrace into, which actually won't really happen, low, we take out an hourly high or low, and it is within a 4 hour fair value gap. 15-minute or 1 hour retracement are better if we have already broken structure on the higher time frame. Better if it's the 4 hour or 1 hour or 1 hour. We have already broken structure. The higher, if we have already broken structure on the higher time frame and are clearly leading in a direction. That's the three steps to pretty much the 3 steps to a trade that I will enter. 1, bias is heavily I feel like I need to move this up. Okay, bias is heavily determined on what liquidity we take out on market open. Things to stay away from FOMC, non-farm payroll, and CPI. These are all the things to stay away from. PPI, less likely for trade success if the PPI made a big move. If it didn't, it made a small move, then we can still have a possible trade. Big red flag, unless there are unless major liquidity levels, if there are discorrelated SNTs, then do not trade. If I place a trade, you risk half the normal amount. SMTs can aid in bias. Usually, high time frame, if you see if it will hold in that direction. Lower time frame to aid in entry. This is the trade plan right here. This is it. Block. Now I'm going to go into an example of the trade plan. This is an exact example of how it went down. Okay, on the 4 hour, if you just ignore these two candles right here, we don't really have a huge bias. You know, overall, we're just kind of like going sideways. We have broken structure and we're kind of going down, you know, bigger time frame. But right now, in the past couple of days, it's just we're in a box, pretty much. There's no clear break of structure anywhere on the 4 hour. On the 1 hour, going into it, that's where we start marking out. See, in the 4 hour, we don't have any like 4 hour fair value gaps. I mean, there's this one right here. It's already been tapped into, but it's this one. We can see if we respect that, if we tap into it, but I don't need to tap into that. Mainly, I notice, okay, we have this high right here. Just an hourly high, not a significant session high or low. And we have these hourly lows right here, which you have really stacked hourly lows. Actually, we have a ton. Kind of helps in wanting to take them out. But regardless, when I enter, I'm going for a 1 to 3, and it doesn't really matter if there's something to target. I'm targeting a 1 to 3 and a 1 to 3 only. I'm not taking any positions off at here or here. I found that really it just depends on if the market wants to move that much overall. Okay, so this is hourly high on the 15-minute. There's no really 15-minute value gaps at all, except for this one, but no fair value gaps. This is really basic hourly high on the 1 minute. Market opens. Okay, we take this initial blowout right here, okay? And this is why you got to pay attention to this correlating pairs. So you have this mini hourly low right here. Okay, and this is kind of a good example of like a good theory that I'm kind of thinking about is if early on in market open, we take out a low or a high, if we take out a level, liquidity level, right when market opens, early in market open, and we like within within a small amount of time, we come up and we take out the opposing liquidity level, and then we start slowing down at that level to the point where we then break structure and have our entry. I feel like that's a good place to be taking a trade. So boom, let's just say this happened instantly. Bam, came up equal highs, almost relatively equal highs, come down, take it out, consolidate, make, this is it. We make fair value gap. We close below it. At the same time, we close below our market structure. Shift to market structure. We're going to short on the retracement back into that or the close on that, but we were so close if we managed. Okay, bam, really small stop right there. But yeah, just target 1 to 3. We could have stopped right here at 1 to 2. At this level is already taken out. Since already taken out, all the way down, but 1 to 3. So that's the plan. I don't know if I have like a 15-minute. Let me try to find like a continuation on the hourly time frame. Well, actually, let's just go back to here because I just found another example. So boom, already found one. Just mark out this one in high right here on a Tuesday in May. The hourly fair value gap. We also took out these highs, but we also just pay attention. Bam, we take that hourly high out. We already kind of took it out on this on ES, but NASDAQ was still holding by the time we opened the market. Okay, so boom. See how untapped 15-minute fair value gap could play out? So this is before market open, but let's pay attention to this real quick. We have a 15-minute fair value gap, unfilled. We retrace into it. Bam, retrace into it. Let's see inversion fair value gap. Oh, we kind of already found it right here. Now we inverse this fair value gap, had that market structure shift. This is just an entry. I won't enter on this, but so that gets taken out. But it's just a point to show how we could respect a 15-minute fair value gap that's untouched before market open. See, and we go up in the higher time frame. But anyways, besides that, market opens, we come up into this level, we take this level out, we retrace into this level, start marking things out. Boom. I want to see this get disrespected. Boom, disrespected. Also, displacement right here. I put it probably right there. Good time. In kind of the macro I want to see. 940, 947. If we retrace into it. Now, the thing is this. With this is we don't have any kind of retracement. Oh, And one thing to notice that we have a fair value gap that was formed before we retrace. So I'm going to enter on the fair value gap instead. Come down almost. Bam. Another A+ setup. Displaced through opposing fair value gap. Market structure shift. Even made a fair value gap that we entered on. Respected it. And bam. Barbecue chicken from there. Then we find like an hourly, like, oh, like right here. Yeah, like right here. Okay, so going into the market, overall, okay, 4 hour, we're ignoring this candle. On the 4 hour, we've broken structure. We have displaced through this fair value gap. Displaced through this fair value gap, not holding this bullish fair value gap. We have broken structure. We have market structure shift and break of structure on the 4 hour. Go on the 1 hour. Going into market open, we have been trending down all London session, okay? We've been trending down overnight. Coming to the market, we have, bam, we have this hourly fair value gap and this hourly low. Now, if we come out on market open, take this out, I would take a long. I'm a little hesitant on the long though, just because of how bearish we are. So I may not take a long because of that. If when there's this strong of bearish market structure on the high time frame, we're less likely to go in the opposing direction of whatever direction we have been going. When it's this strong like this, but we are overall in a bullish market, and this could be just a retracement from this low to this. So you also have to be aware of that. And we could just be equaling out in equilibrium to go higher and already bullish on the daily, and we're in a daily fair value gap, you know, but we have been going straight up, haven't rebalanced this entirely, but when we're at all-time highs, it just, don't try to change the direction, or when we're at all-time highs, when we keep going up, we're going to keep going up until we don't. So that's also something. But with all that out of the way, going to the market open, so you kind of already retrace into that. But this is the key: overlapping fair value gaps. So within this hourly fair value gap, there's a 15-minute fair value gap that we could retrace into. So let's just see what happens. Okay, so we retrace into this 15-minute fair value gap that's untouched. In this 5-minute, we're overlapping, constantly just overlapping. So let's see. So we retraced all the way up into that. I guess it's good to look at like this. Yeah, we definitely haven't done nothing on that. Took out a low or anything. So now I'm looking for this fair value gap combined to get taken out. Unless we make a low right here and displace through this together and market structure shift. Okay. So there's this right here. Gonna make this. Okay. Bam. So would enter on the retracement into this order block, but we made a fair value gap. So I'm gonna do this. Probably put stop by right there. Target on 1 to 3. See what happens. Okay. One thing to note on this is that one, I'm not entering now on these fair value gaps. I'm not entering on this fair value gap. I'm not entering on this fair value gap. I'm only entering on this first fair value gap, which is also a BBR, I think it's called. I forgot the name, where we inverse a fair value gap, and within the inversion fair value gap, we create a fair value gap. Crazy work. But if you look at this, one, I'm not going to change my stop to make it a higher risk of a trade. If I would have done that, I'm out. I mean, with a no. I want to make my stop bigger to make a lower RR. That's the reason. And also, our entry is within the equilibrium retracement of this time frame. And also, if we want to get into it, it could also be right in the golden zone. So, boom, right there. See what happens. Okay. Going. Bam. Just like that. Just to show you. Yep. Retraced all the way, even higher than that. But yeah. So this is a great example of both an hourly sweep of liquidity or a retracement into an hourly fair value gap and aligning a 15-minute untouched fair value gap within an hourly fair value gap. So actually, I'm going to add into this. I'm going to add into this if high time frame price action is heavily pushing to one direction, do not trade against that direction. Just like within that previous example I showed you, where we had a high time frame break of structure slash push, high time frame break of structure slash push, we are not trying to catch a falling knife. We want to go with the direction the market is going. So this means possibly missing out on a trade, because if the market went down and took out that low and then went up there, it's more likely I'm not going to take it because it's not going to go high. One, because a market is what is the thing they use? Is it listening? Whoa. I don't know what they use. I don't know what they use. But if the market is going down in the hourly example, it's and we take out this level, we're only going to go to rebalance stuff. You know, if we've been going this far, that without, you know, we're not going down, up, down, up, down, up. If we're going straight down strongly, and this is the first retracement up, we're not just going to go in a V shape. It's more likely we're going to go down, come up a little bit, and then come down. And if it doesn't keep going in the same direction it was going in, it's going to come down, come up a little bit, and just kind of chop around and consolidate, because there's accumulation, manipulation, and distribution. We're not going to come down so far and then instantly go back up. It doesn't happen. It has to go down. If there's a strong push somewhere, it's going to accumulate before changing directions on the high time frame. So keep that in mind. This is what the bias is. I mean, this is what the trade plan is. Gonna make millions of dollars. So yeah.